Thank you, everyone, for joining us. We are going to go ahead and get started in about 2 minutes. Thank you, everyone, for joining us this afternoon. We are going to give it a couple more minutes to see if we have any last-minute folks roll in. Okay, I'm going to go ahead and get started in the interest of time here. I'll go ahead and provide an introduction as we have some additional folks roll in here. Thank you for joining us this afternoon. My name is Ashlyn Levitt, and I am the Assistant Director of Events and Volunteer Management for Grand Valley's Alumni Relations Office. We have invited you to join us for lunch every Wednesday in February as we dive deeper into a variety of key financial topics. So far, we have learned financial basics and the 6 barriers to financial success together. Today, we will focus on college planning essentials. Before I introduce our presenter, I do have a couple Zoom keeping notes. This presentation is recorded and will be accessible on the Financial Sense website. Please feel free to submit questions using the chat feature. At the end of the program, we'll take questions before wrapping up right around 12:50. With that, if you have joined us for any of our other sessions in this series, you may feel like you know Melissa well by now, but for those who are joining us for the first time today, I have the pleasure of introducing Melissa Stewart, a '09 GVSU alum and financial advisor. We are lucky enough to have her facilitate our program this afternoon. As the founder of Clear Vista Advisors, Melissa's mission is to help provide people with a clear view of their financial future. Melissa strives to take complex investment concepts, retirement plan best practices, and financial planning topics and simplify them for her clients. At Clear Vista Advisors, Melissa believes in tailoring customized service approaches and solutions to help clients meet their unique situations, industry, and demographics. Melissa, thank you so much for being here this afternoon. I'm going to go ahead and stop sharing my screen so you can share yours and start your presentation.
Sounds great. Thank you so much for that warm introduction. I appreciate it. Can you hear me okay?
Yep.
Great. And hopefully you can see my screen now.
I can.
Great. All right. Thanks so much. So as Ashlyn said, my name is Melissa Stewart. I have been in the finance industry now for about 20 years. Graduated from Grand Valley State University with a degree in business and business management and finance, double major. After graduation, I went on to get my certified financial planner designation, accredited investment fiduciary, as well as some additional education and designations along the way. When I'm not busy running Clear Vista Advisors, I am chasing after my four-legged friends or my now 13-year-old or daughter or my 10-year-old son. So, but I do enjoy volunteering, and I was formerly on the Grand Valley Alumni board, and currently I serve on the board for Safe Haven Ministries here locally in West Michigan. So I'm just really, really happy to have you join us today to talk about college planning essentials. So we'll move on to that. So as you're going to see on today's guide, it is brought to us by JP Morgan Asset Management. So as a financial advisor, I have a ton of tools and resources that companies like JP Morgan make available to me to help guide these conversations with my clients. And so that's why we're using their guide today that they prepare, and they update it annually. So if this is information you want in the future, you can always look for this guide online, and it's usually available for you. So we're going to get started today. And the first part of today's discussion, we're going to be talking about why does college matter, which I'm sure, we're here on behalf of Grand Valley State University. So I think we all hopefully know why college matters, but we'll really dig into some of that data and those numbers. Then we're going to talk about college costs currently and what they're projected to be in the future, just based on their current trend. We'll move on to financial aid options available to you and discuss some financial aid, what that might look like. Section 4, we're going to go over investing and saving. And then the last is Section 5. We just actually have some additional good data to review with you today. So today's going to be, bear with me, because today's going to be a lot of numbers, which as a financial advisor, I get geeked about. But it's just a really, this presentation today is packed with a lot of great information. Now, I will tell you, I am not a student aid officer. I'm a financial advisor. So again, I know enough to help guide my clients through this conversation. And then I recommend that they reach out to the specialist, like student aid officers at the institutions they're looking at potentially attending. So college matters. 86% have higher annual income for bachelor degree holders versus those with just with a high school graduate. When it comes to college costs, 78% of families having to rule out college because of the cost, which is really sad, right? When we know that there might be some help available to them. 324% increase in student loan debt since 2005. So we're definitely seeing a lot more people leverage student loans to help pay for college. But we can talk about how that's going to be beneficial for them based on the increased income they get. And then 67% of families are not using tax-advantaged 529 plans to invest for college. And so we're going to talk about the benefit of 529 plans a lot today. As we get going, I know we're probably going to have some question and answers. Because we're going to cover so much information, I just encourage you to write those questions down today as you're having them. And then at the end of the presentation, if we have time left, definitely we'll be happy to do some Q&A with you. But today's session is going to be pretty jam-packed with information. All right. So if you didn't know, a college diploma opens the door for a lifetime of higher earnings. So right now we look at the average annual earnings of just a high school graduate versus a bachelor's degree versus a professional designation. College pays for itself. $38,930 extra income for an average bachelor's degree holder in just 1 year is enough to pay for 3 semesters of current in-state public college costs. So that higher income potential that you have with your college degree really can help pay for the money that you invested into that college degree due to lifetime higher earning. But there can be a major difference based on the career path that you choose. So choice of college major has a significant impact on a graduate's starting salary. And sadly, only 62% of families don't discuss starting salaries. I know when I was in high school and we were thinking about different degrees as part of that prep, they told us to say, hey, let's go and look at what that average job would earn for you. And then let's look at what that college degree is going to cost you, just so that you have an idea of, going into the degree, what you might be able to expect once you earn that degree. So this was as of 2002, and then we're seeing like the increase in those salaries over any given year, based on in-demand industries right now. More education equals less unemployment. College graduates enjoy much better job security and opportunity, especially during economic downturns. So we go back to the early 2000s and we had the tech bubble burst. And then in 2008, 2009 is kind of another time period we call the financial crisis, or the Great, it was the Great Recession, not the Great Depression, but the Great Recession we call that because of how big of a drop the market took. And then in 2002, when we had COVID. So we're seeing here that when you have a college degree, the average unemployment rate is only 2.1%.
Hey, Melissa, I'm so sorry to interrupt. I'm not sure that your slides are updating.
Showing? Oh, no.
Yes.
Well, that's not going to be helpful. Let's try again. Hold on, not that one. Stop share. We want to go to.
There we go. Thank you.
All right, well, we'll backtrack that a little bit. Thank you for saying something in the Q&A. I appreciate that. So this was the first chart just showing the income differences, and we are going to send these to you after today's presentation. So thank you so much for letting us know. But high school graduate versus a bachelor's degree average annual earnings versus a professional degree average earnings. And then, it would take about 3 years, or 1 year to pay for 3 semesters in college based on those increased earnings. Okay. So it is worth it. And here we have the different industries that we were talking about and the different average incomes that they're earning currently with their college degree. And the fact that 62% of families are not discussing with their students, potential students, with their children, okay, what degree are you thinking about getting? And then let's just have a discussion about what you should what you can expect to earn from that. And then I move on to even say, let's have a discussion. Okay, how much is that degree going to cost you? And then also just how much is daily living going to cost you? Work with your children to create a budget to say, okay, it's, gas, groceries, everything, so that they can kind of compare how much is life going to cost them versus how much can they expect this degree to earn them. And then we have the different unemployment rates based on the different time periods here, tech bubble versus financial crisis versus COVID. And we're seeing here that if you have no high school diploma, we're looking at closer to a 6% average unemployment rate versus 4% for those with a high school diploma but no college, versus 3% for some that have some college, and then a 2% average unemployment rate for those that have a college degree. And then we have tuition inflation. So college tuition costs have increased much faster than other household expenses in recent decades. Okay, and why has it cost more? Colleges spend more money to attract the best students possible. Colleges are hiring more faculty and administrative staff. Colleges receive less financial support from states. We're also seeing we have a demographic thing going on right now where there's just less students. There's a decrease in our population. We have less students going to college now. And it's not necessarily because they're choosing not to go to college. It's because we actually just their demographic, the population is lower at the college ages. So colleges, in order to sustain the institution, are having to charge a bit more. Future four-year degree college costs. So this one kind of shocked me a little bit. The younger the child, the more college is likely to cost due to the inflation. Add up 4 years per child and it equals one of your family's largest expenses. So currently, if you have a student that's 18 years old, we have public colleges here on average, and in-state public, green, how much is it going to cost them over 4 years? Out of state, and then what if you're looking at a private college? And I want to remind you that this is just the total cost. This isn't taking into account any scholarships that you might get from the college or financial aid that you might get. So sometimes when we look at that total cost, like when you're looking at some like local colleges, that I work with, they say, well, that's the total cost, but you might be eligible for some scholarships or for some financial aid discounts. So this, that's not taking this into account. So keep that in mind. The community college option. So that is actually what I did. I went to 2 years full-time at Grand Rapids Community College. For me personally, it saved me a lot of money. There's pros and cons to it. I think you have to talk to your student about whether that's the right option for them or not, especially if they're not sure what they want to go to school for. For me, it was just straight a financial decision. So didn't have a lot of money, and so I just chose to do my first 2 years at community college. And then I moved on to Grand Valley State University and did my next 4 years going to school at night so that I could help pay for college along the way. So when we look at, some students choose to attend 2 years of community college before transferring to a 4-year institution. And I will say that when I went to Grand Rapids Community College, give them a little plug too, along with Grand Valley, they worked so well with Grand Valley to make sure the credits I got at community college would all transfer over to my 4-year degree then at Grand Valley State University. So great program, something definitely to consider. You can save 40% by attending 2 years at community college. So something for consideration. Preparing for more than 4 years. Most students take more than 4 years to earn a degree, which increases their total cost significantly. It can. So currently we're looking at today's dollars. If you can graduate in 4 years, on average, we're looking at it costing you about $103,000 over those 4 years. If it takes you 5 years, say 28% higher cost. If it takes you 6 years to finish that degree, 58% higher cost. So also, how can we help students stay focused so that they can graduate in those 4 years if possible? Then we're going to move on over to our financial aid overview. So financial aid, college costs continue to rise while financial aid has actually slightly declined over the years, leaving families to pay more of the expense. So as you can see from 2012 or 2022, so over the last 10 years, we've seen in-state college costs go up about 30%. And we've been seeing financial aid go down about 4%. So nowadays, families are being left with about 50% of college cost from their income and their investments. And 10 years ago, they ended up paying for about 38% of college cost. So again, we have this college cost, and then we have financial aid that comes in to help pay for that college cost. So just because we see that's the cost of going to an institution doesn't necessarily mean that's what you're going to pay, because it's not taking into account financial aid. So when we think about grants, how many people are getting grants and how many people are getting scholarships? So when we looked at 2022, need-based grants, 57% of families received some sort of need-based grants. And then you can see how it is based on private college versus public versus community. The average amount was about $5,900. And then scholarships, which are more merit-based, 61% of families receive some sort of scholarships. And it can differ based on the institution that you go to. So that averaged about $7,800. Okay. We have these federal Pell Grants, which is one of the most popular federal grants out there. And will you be eligible to get it? It really just depends on your income, your family size, your marital status. So for example, if you have a 2-parent household with two kids, to qualify for a Pell Grant, the income would have to be under around $48,000 or lower to qualify for a Pell Grant. 0.3% of college students receive enough grants and scholarships to cover all the costs. So very few are getting enough money to cover everything. So we have to be thinking about, okay, what can we save, or what options are best for us? Because to think that you're going to get a free ride to college isn't necessarily the case nowadays. What about athletic scholarships? Athletic scholarships usually only cover some of the college costs, and only a select few actually receive them. So here we have the public college cost is about $24,000 a year currently. Division I women who get it, Division I men. We have Division II here. Full ride scholarships are available only for those in Division I sports. So you should note that too. And then what are the odds that my athlete gets a college scholarship? So chances of a high school athlete playing college sports is 7%, and chances of them receiving an athletic scholarship. And this is just nationwide stats, okay? So I don't have the specific stats for Grand Valley State University, but chances of them getting a scholarship on a nationwide basis is 2%. So what is your federal financial aid eligibility? The Department of Education calculates your student aid index, or known as your SAI, used to determine your financial aid eligibility. So total college costs each year minus the student aid index equals your financial aid eligibility. When to apply? You apply as early as October 1st of the year before you start college, and you must apply each year in college. And then we go into, this one's a little bit more detailed, but again, we're going to provide you a copy of this presentation. How is this calculated? So a family's annual income, including the student, counts for far more in the formula than savings and investments. So sometimes there's this misconception out there that, oh, if I have a lot of my savings or a lot of my investments, it's going to hurt my child's ability to get some financial aid. And that's not necessarily the case. So here we have the parent's income. And depending, again, this is on the size of your household, how many dependents are in the household. Based on the parent's income, 22 to 47% of their adjusted available income counts towards the financial aid, like how much can they put towards college and pay for college each year. And then they look at your investments, and they look at 5.64% of your non-retirement assets above the protected amount. And you can look up the protected amount. There's a certain amount they kind of let you have to the side that they say, you know, we can't touch this. I want to say it was around $20,000, but don't quote me on that. And then there's this misconception too. Well, if I saved in a 529 college savings program for my child, that's going to hurt their financial aid eligibility. But they only look at 5.64% of that each year. So we're not really trying to harm savers when we look at this type of calculation. Then they look at the student's income. The student, 50% of their income above the protected amount. So here you see the protected amount is $11,000 for a student. For a protected amount for a family, it depends on the size of the family. So that's why that number is not quoted here. So 50% of the student's income, and then 20% of what a student has like in their savings accounts or in their investments would count. Okay, and that equals a family's total SAI, so total cost of college minus total SAI, and then we start saying, okay, there's a gap here that we have to make up, and that's where financial aid comes into play. There was some big changes that happened back in this year, actually. They were passed last year. So when it comes to new rules for 529 education plans, and we'll talk more about here shortly, that could help increase aid. Withdrawals from accounts owned by grandparents and other non-parents no longer reported to student income. So it used to be if my grandma or grandpa set up a 529 plan for me and I withdrew from that while I was going to college, they would count that towards my income. And so they would say the next year, they would be like, oh, 50% of that withdrawal counted towards this calculation, right, as my income. And they're not doing that anymore. Only accounts in the student's name are reported as parental assets. So previously include siblings, so they've changed that. Income and asset reporting, pre-tax contributions to employer retirement plans, worker compensation plans are no longer counted as part of your income. So if you're a parent and you're maxing out your 401k contributions, they're not going to look at that as part of your total income each year. That's eligible, you know, for this part of the equation, the 22 to 47%. So that's nice. Child support is treated more favorably as an asset instead of income. So that's nice. Because we saw assets only count as this like 5% calculation, right? In other provisions, they expanded the federal Pell Grant eligibility for lower income families, and there's more opportunities to appeal a financial aid decision as well too. So those are all benefits that could help. I'm not going to go because I am going to give you a copy of this presentation. So I'm not going to go into things that could decrease aid because we have a lot of more great information to go over here today. So there's this quick little chart here that we're providing that's going to help you estimate it. You can, and when you get this presentation, this is a hyperlink for you. So you'll be able to click on that and you'll be able to run a little estimator for what you think your SAI is going to be. But here we go. Income has a much bigger impact than assets. So here, let's say I have $25,000 in my savings account. I'm a parent. My kid's going to college now. I'm trying to figure out how much am I going to have to pay towards this. So let's say I have $25,000 saved. That's not retirement money, it's just in my savings account. And let's say that my combined income for my family is $125,000. I'm going to say there's two people working in the household. So our combined income is about $125,000. So with that, we're going to see that they're going to say, oh, Melissa, you can pay about $18,000 a year towards your kid's college based on that information. Now, remember, next year, if I have to deplete my $25,000 for whatever reason, then I don't have to put as much to it, right? And this is for financial aid eligibility, and we'll talk about student loans here in a little bit, because a lot of people have to take some student loans to help meet this gap, right? I mean, right now, for me to take an $18,000 cut in income to put towards college would be really difficult. So that's where student loans can come into play. Okay. Families that don't invest enough for college often have no other choice than to borrow, right? So average outstanding college balances in student loans right now, we see on the average right now, we have about parents with about $30,000 in a student loan balance and students with about $25,000 in student loans. So, and then debt balances in 2005 versus 2023, we're seeing, student loans have grown the most. So with the more people are taking out student loans to pay for college is basically what this is supposed to show. So there are different ways you can save for college. And honestly, the most tax advantage one, in my opinion, and the best one out there, and granted, my compliance team will love this, I'm here to give you education today, not advice. Advice is really specific to your situation. So if you have questions, you're welcome to reach out after today's presentation. But in my opinion, for most people, 529 plans can be one of the best way to save for education. And this chart looks at different types of accounts. So these ones, educational savings accounts. So you have a custodial account, you have a 529 education savings account. You get tax-free investing and withdrawals for qualified educational expenses. So that's really what makes those the most tax advantaged. You have another thing out there, another type of savings account for children called an UGMA or an UTMA. Custodial, we'll just call them a custodial account. And then you have Coverdale ESAs, educational savings accounts. But they each have the annual contribution limits on 529 plans are higher. They're more tax advantaged. And then there's some other features here too, that this one just came out, and we'll talk about it in a second, where if there's a balance in the account, you can roll some of that over into a Roth IRA for your child. So don't just save, invest. Many families use retirement savings accounts for college instead of taking full advantage of 529 plans. So percent of families using each vehicle. How are families paying for this? Most families are using some of their own savings. After they deplete their savings, they're kind of looking at 401k or retirement plans for this. And then the next most popular one is the 529 education savings plan. But those are more tax advantaged. So that's why we would say we should use those over your normal investment or savings accounts or your retirement accounts. So how much do I need to save? See how much you should save each month based on your child's age to help fund their college. So monthly investment, and this is just an average chart of what you might want to consider saving. We would encourage you to meet with your financial advisor if you want to be exactly on track for your child's college education. But for, let's say you have a newborn baby and you want to help pay 50% of their college education for an in-state, we would say you want to save about $326 a month. Okay. If you want to fully fund that college, we're going to say $651 a month. Now, personally, as a financial advisor, I know that when I had my children that are now 10 and 13 years old, we did not have $650 to put into college savings for them at that point in time. But something I've encouraged, because what we learned is that daycare costs a lot of money. I don't know, you're looking at maybe about $50 a day per kid for full-time daycare. So what I've been encouraging younger families to do is to take that daycare budget once the kid goes to preschool and kindergarten and move that daycare budget. And now let's start saving that for college. You weren't used to living off of that money anyways, so move that money towards college savings. Just an idea. The sooner you start investing, the more time you have to grow the money. So this is, what if I start saving $100 a month at birth versus $250 a month versus $500 a month? If you start saving that at birth with some assumptions, with some rate of return assumptions on average, these are what we would expect their college account to look like before they head off to college. But what if I start saving at age 6? So this is kind of like the concept I had of, well, you know, once they hit preschool and kindergarten, start taking that daycare money and putting it aside. You can see what you're on track for here. And what if I start saving when they're at age 12? So saving something is better than saving nothing. However, the sooner you can start, the better, because that gives it more money, time for that money to compound and grow. And oh, I love this concept too. They put it on autopilot. So you can usually just have a deduction come straight from your bank account each month, kind of like a bill you're paying, or directly from your paycheck to go into these 529 accounts to help you save from college. That way the money doesn't even hit the bank account. Tax efficient investing. So why do we love 529 plans? Well, here's really the reason why. It lowers your taxes and it creates a larger college fund for your children. So assuming when your child was born, you threw $10,000 as the initial investment in, and then $500 monthly contribution over 18 years, and a tax-free 529 plan, because those investments get to grow. So how a 529 plan works is the money you put into it, you might get some state tax deductions for. And then that money grows tax-free. And when you take that money out at college, you never have to pay taxes on the growth that was in the account. Okay. If I just used a normal bank account or investment account, every year I have to pay taxes on the dividends and interest and capital gains in that account. And those taxes at the end of the day leave less money in that account to pay for college. So that's why we like 529 plans. Okay. So the average return, like you have 6% more in your 529 plan than in your taxable account due to the tax efficiencies. So this chart goes into a lot more detail about why we love 529 plans. So go ahead and take a look at that at your convenience while we dig in some additional information today. So what can I use a 529 plan for? They're very flexible. It used to be we just thought of 529 plans for higher education expenses, but now it can be used for K through 12 expenses too. So you can pay for post-secondary education, tuitions, room and board, books and supplies, computers and related equipment, and apprentice programs. Okay, you can use those. Other expenses that can now get paid for with 529 plans, some education loan payments, K through 12 tuition can get paid, and then some special needs services. The rules vary state by state, so if you have questions about that, we can help get you some additional information. And then what if I save too much in my 529 plan? The nice thing about a 529 plan is if there is money left over at the end of college, you can roll over up to $35,000 from a 529 plan into something called a Roth IRA. And once that money is rolled over to the Roth IRA, it continues to grow in the Roth IRA tax-free. And if that happens until and is invested and grows in the Roth IRA from the up to age 65, when your child retires, they would have about $615,000 in their Roth IRA to help fund their retirement. So that's a nice new feature that was just issued in 2024 for when there's a surplus in a 529 account. Catching up on college investing. So by funding a 529 plan with manageable amounts from multiple sources, you can get on track. You can have significant money to pay for college. So here's an idea for you. Every month you start saving $500 a month to help fund your child's college. Okay, that's going to take care of about 40% of their college costs. It's going to leave you with, based on these assumptions, we're assuming a 6% growth rate. It's going to leave you with about $61,000 in their account at college. And then every year you get a little bit of a refund. So you put $1,000 every year of your tax refund into the account. Now we have $71,000. So we're funding 47% of their college for public, in-state public college. You know what? I usually get a bonus at work, hopefully, knock on wood. So I take that bonus each year and I put it into the 529 account too. Well, now at the end of the day, we'll have $92,000 towards that college education. And then lastly, I let my family members know about this 529 account and I say, hey, Junior has plenty of toys. Don't buy him more toys for Christmas. Instead, help fund his college. And actually, a lot of these programs have a link that you can send to family members, like the grandparents, and say, hey, consider contributing to Junior's 529 plan. So don't pay for college with retirement funds. So as a financial advisor, my practice really focuses on working with retirees. And unfortunately, I see families that sacrifice being on track for retirement for their children's college education. And your children can graduate from college with some student loans, and maybe you can help them out a little bit along the way. But then they have the rest of their life to help take care of those loans and pay off those loans, right? But you are by the time my kids go to college, how old will I be? I'll be like close to 45, 50 in that age range. I don't have as much time to save and let my money grow for retirement. And so here we see, what does it look like when my child goes to college, what it looks like if I take a $10,000 withdrawal out for college. When I retire, I will have $32,000 less in my retirement savings because of that $10,000 withdrawal. If I take $25,000 out, it's an $80,000 difference in my retirement savings when I retire. And if I took $50,000 out, it would be potentially $160,000 left less in my retirement savings due to that withdrawal. So just be cautious, like we really should be cautious of using retirement savings when it comes to paying for our children's education. And as a parent, I want to give my children the best opportunity possible to succeed in this world. And so it's a difficult conversation to be having, but definitely something I'd say, if you have a financial advisor, consult with your financial advisor about the long-term impact on your retirement savings if you use some of that to pay for college. It's not always the wrong decision. It's just you need to understand the numbers and how they work. So K through 12 withdrawals impact college savings. So let's say you do choose to put your children in some private education for K through 12. This is the growth of a $500 monthly investment over 18 years. But then, so that $500 monthly investment, and then annual K through 12 withdrawals, we see here of $10,000. So the annual withdrawal is up to $10,000. Here, we can see how that impacts how much money is left over for college when your child does go to college. Okay. And then this is just talking about the benefits of investing. So what does it look like if we invest in completely stocks versus something that's more conservative called bonds? Versus what if I do half of my investments in the 529 plan in stocks and half of it in bonds? And then what if I just put that money in cash? My average rate of return. So we look at what is the over 18 years, what's the best rate of return we've seen in the stock market versus what's the worst rate of return we've seen in this time period from 1983 to 2023 over an 18-year time period. Okay, so over 18 years, the worst rate of return during this time period was 5.5% for someone that invested in the stock market. I won't get into too much investing today because I think this is a good time to just take a break and talk to you about, and again, not giving you necessarily advice. No advice is being given today, just education. But if you're thinking about a 529 plan, I usually direct a lot of people to misaves.com. It's the Michigan Education and Savings Program. It's the Michigan sponsored 529 plan. So if you are in the state of Michigan, and each state usually has one that's sponsored by the state that will give you tax deductions at the state level. So this has a quick little, and we're not going to play it today necessarily, but talks to you about the tax advantages of a 529 plan. And I use this one for my own children. The fees are super, super low in it, and they make investing really easy. I just basically need to put in there the age of my child, so it knows when my child's going to be 18 and when I'm going to need the money, right, for college, if I'm using it for college and not K through 12. And then do I want to be aggressive with my investments, moderate or conservative? And then they pretty much take care of it for you. So it's super nice and easy to use. So just a little plug in there for misaves.com, the Michigan Educational Savings Program. And there's a ton more information on this website to learn more about this program. Okay. So that's where I'm not going to get too much into investments today because they do really make the investment portion of it fairly easy, even for a person that, I usually think we have two types of investors. We have like the do it for me, can you just take care of it, or the I'll do it myself. And that program has both options available for you. So, college preparation timeline, planning in advance and filing early for financial aid may help students get into preferred colleges, right? If they're trying to figure out how to divvy out the financial aid, I want to be at the top of the pile, not the bottom of the pile. So when you're a high school junior, begin researching colleges, consider taking the testing that you're going to need to apply for colleges, begin to formulate a list of colleges, schedule your college visits. And then if you need to, this gives you time to retake the testing like the ACTs or the SAT, take your appropriate AP exams if needed, write your college essays, get recommendations, and then finalize your college list, okay? And then if you're a high school senior, we need to be thinking about filing our FAFSA, which is what's going to make you eligible for financial aid. Other colleges and universities have another program, another filing that they're going to want you to do. It's called the CSS. That applies for their financial aid eligibility. So that's unique to just some colleges and universities. Apply early, make an early decision, consider your acceptances, and then, and then you'll be starting college. So that's where we'll go with that. All right, we have a question on student loan repayments. I'll get to that towards the end of today's presentation. So I'm gonna dig through the rest of these slides here real quick, and then we'll do that in the Q&A portion. So thank you for the question. It's a really good question. So I'm not going to spend talking about endowments, but colleges and universities do have endowments to help pay. That's what's funding the scholarships and some of the financial aid programs. This, because we're getting to the appendix now, which is just some additional resources to you. So if, here you have the website for FAFSA, the CSS profiling, studentaid.gov, a lot of great information right there for you. Collegesavings.org goes into a lot deeper dive of the college saving options if you're looking for additional education on that. And then if you're thinking about grants and scholarships, here are some different websites that you can be looking for grants and scholarships. Okay. And then we just talk about some of the different types of grants and scholarships available for you. So we'll send that information out to you after today. And then this is just talking about the two different applications, the FAFSA versus the CSS profile. So about 250 colleges require the CSS profile, and it's a lot more information to determine your eligibility, which is not like federal eligibility because the FAFSA is federal and the CSS is for the colleges and institutions to figure out how much financial eligibility they may be able to provide for your family. So talk a little bit about different grants out there, a sample of the grants, and then the award limits to those. And then the different loan programs available out there too. So you have your direct subsidized loans, you have your unsubsidized loans, you have your direct plus loans. So they're looking at what is the interest rate on these different types of loans, and then what is the annual loan limit that you can take out each year to help provide towards college. So you're filling out your FAFSA to really figure out what am I eligible for as far as grants go, which you don't have to repay, versus student loans go. And then some people are looking at it too, saying, well, what if I just took out a private loan? What if I use my home equity line of credit? What if I use my life insurance or my Roth IRA? And so this chart just goes into a little bit deeper dive of other areas that people use to fund college savings and pros and cons to each. But as we said before, we really like our tax advantage 529 plans. And so we talk about income limits, tax benefits, federal tax credits, talk about student loan interest and some state tax deductions. So with that, I wanted to go into also in this presentation in one of the slides, and so you'll see it in one of these slides here, but there is a college estimator link. So you say, I'm planning on going to college in Michigan. We have 4 kids. We make X amount of money. My child is 7 years old, and it's going to kind of show you, project for you what you can expect the cost of college to be. So I think that's really helpful too. So with that, I'm going to stop sharing my screen. I actually have one more slide for you here real quick. Hopefully you can see this slide. This is our contact information. So if you want to reach out to me, you have some more additional questions, feel free to do so. I'm happy to support you any way that I can. And then my compliance team always loves me making sure I get my proper compliance disclosures on there for today's presentation. But with that, I'm going to stop sharing my screen. And we did have one question. All right, do we have time for that question?
Yeah, let's do it.
Okay. Do you know of anyone? So let's see here, screen share stop. Okay, so the question is, do you know of anyone who can provide guidance on federal student loan repayment? And it's hard to know which options are best. Income-driven repayment. So some employers work, or some associations that you might work with. The best one out there that I know of, and you have to see if you're eligible to work with them or not, but it's called Savvy. It's SAVI. And if your institution, like your employer, works with them, which some higher education institutions do, or maybe like something else you're affiliated works with them, they'll go in and look at your student loan information and really tell you like the best way to pay down your loans or the best programs available to you. And then you can either take care of that yourself, or you can pay them an annual fee and they'll help take care of it for you. Otherwise, I would say really it's just the, and I'll send a link out to some of these websites, but it's the federal like student loan forgiveness program. I have a link. I think it's financialaid.org. I'll reference that in the follow-up email. I'll give that to Ashlyn so that we can get you that information. so that you can do some additional research yourself. I personally don't have any companies that I know of that do like the private student loan counseling. I know there's ones available out there, but I don't have any referrals or recommendations for you at this time for that. Any other questions today? All right. Well, like I said, I know that was a ton of data. So great job bearing with us today.
All right, I'm going to take over screen sharing here. Thank you everyone who joined us this afternoon, and please join me in thanking Melissa for her time and expertise in bringing yet another informational webinar to us. We hope you will join us next Wednesday at noon for the last session in the Financial Sense series, Learning the Lessons of Time. While today's market headlines may feel new, they are not unprecedented. History shows that markets will rise and fall, and crises will come and go. That's why having a disciplined approach to market uncertainty may be the key to your financial success. Please keep your eyes on your emails, as we will be sending we will be sending a follow-up email and additional resources, as well as the recording to you later this week. I also encourage you to visit our Financial Sense website to see what other sessions, if you are unable to tune in for other sessions, what we had going on there. Lastly, please remember that as Grand Valley alumni, our commitment to you is as a Laker for a lifetime. We will always be alongside you and all of our alumni, ready to help you reach your next career and life goals. No matter what stage of your life or career, you can turn to us for a lifetime of support. With that in mind, you can find both additional resources and future events by checking our website out at gvsu.edu/alumni. Thank you again for joining us.
Thank you. Have a good day.
Thanks. Thanks, Melissa.